Hi everyone, welcome to this edition of Take Charge Now. Like everyone else, I'm talking capital gains tax, the proposed changes from the most recent budget. Here's just a little bit of a background. When you have a capital gain, you have disposed of an asset that you own. It could be a stock, it could be a property. And when you do that, if you have made money on it, 50% of that is taxed at your marginal tax rate. The proposed changes say that when you sell that particular investment or asset, 50% will be taxed up to $250,000, and the amount then goes to 66% on amounts over $250,000. So let me give you an example. Let's say you have a stock, it's worth $2,000. When you sell it, it has an adjusted cost base of $1,000. That means what you paid for it minus any expenses associated with acquiring it. That means that you have a capital gain of $1,000 and you pay on 50% of that, so you pay taxes at your marginal tax rate on a $500 gain. That's very simple, but that's sort of how it works. So if you stand back and you say, is this going to impact me? Well, it could, and this is where I sort of disagree with the government. The government said that this will only impact 99.87% of Canadians. I have to think about that, because if you're someone that has built up a non-registered investment portfolio, it impacts you. If you have a rental property and you dispose of it, it impacts you. You may have a second property by way of a cottage. Yeah, it impacts you as well when you go to sell it. And so I do think that there are numbers of people that are going to be impacted. I mean, this does not come as a surprise to anyone, and it doesn't, because it's long been thought of as low-hanging fruit for the government. As the debt levels have grown, they've got to build back up those coffers, and one way to do it is to tax presumably the wealthy, but also those who are in middle class will be impacted as well. So it's something to think about. It is complex. You do and should talk to an accountant, your financial advisor. But here's the thing with capital gains, and just something that you can think about. If you have had a capital gain and a capital loss in the same year, you can reduce the amount of tax you pay on the capital gain by deducting the capital loss. And by the way, if you sell something at a loss, you can go back 3 years and adjust your tax filing with CRA to get a reimbursement on some of the taxes you paid. Or if you have a loss and you don't want to use it right away, you can carry it forward indefinitely. And here are just a few things from a tax perspective that I think you might want to consider. If you have money and you don't need it in a non-registered account, put it in a registered plan, like an RSP or a tax-free savings account. Tax loss harvesting is what I was just talking about. This is where you offset gains against some of the losses that you have to wind up paying less in tax. And track all of your expenses. That's how you bring your adjusted cost base, what you paid for it, down, because you get to deduct things like legal fees and management fees and trading fees. The bottom line is, this has not been passed yet, but when I'm thinking about planning taxes, look at your current situation, take into consider the proposal. And by the way, this is all expected to come into play June 25th for an individual. There are things you can do today to maximize your financial situation, but at the end of the day, rarely do people let taxes drive their financial decisions. It's often a secondary consideration, a big one, but often secondary.